Stocks are up, bonds are worried, and the gap between those two signals is one of the most important things in markets right now. Wall Street posted solid gains in the latest session, driven almost entirely by a surge in technology shares. When large-cap tech companies move sharply higher, their sheer weight inside major indexes pulls the broader market with them. That is exactly what happened. The headline numbers looked strong. But underneath that rally, the bond market was telling a different story. US Treasury yields remained elevated, a sign that bond investors are still uneasy about inflation. To understand why that matters, it helps to know how bonds work. When investors worry that inflation will stay high, they sell bonds. That selling pushes bond prices down and yields up. Higher yields are essentially the bond market's way of saying, we are not convinced inflation is under control. That concern has real consequences. Elevated yields raise borrowing costs for businesses and consumers alike. Higher borrowing costs squeeze corporate profits over time, and they can slow the broader economy. So while stock investors were celebrating, bond investors were flashing a caution sign. The Federal Reserve is watching both signals closely. The central bank has been holding rates at restrictive levels, while it waits for clear evidence that inflation is cooling. If bond markets are right, if inflation stays stubborn, the Fed has less reason to cut rates anytime soon. And a Fed that stays on hold longer than expected is a headwind for stocks, particularly the high-growth tech names that have been leading this rally. For now, equity investors appear willing to look past that concern. Optimism around corporate earnings and confidence in the resilience of large technology companies are keeping the stock market bid. There is a bet embedded in that posture, a bet that inflation will cool, that the Fed will eventually ease, and that earnings will hold up in the meantime. Whether that bet pays off depends heavily on the data ahead. Upcoming readings on consumer prices and labor market conditions will either validate the stock market's optimism or give the bond market's caution more weight. This split, stocks confident, bonds cautious, is not new. It has been a recurring theme through much of the past 2 years. But it is a tension that tends to resolve eventually, in one direction or the other. Either inflation cools and bond yields pull back, giving the rally more room to run, or inflation persists, yields stay high, and the pressure on stocks builds. Watch the next inflation print closely. It will do more to settle this debate than anything happening on the equity side of the market. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.